the Fed comes out and announces with kind of covertly that they may stop quantitative tightening, which begs the question, are they considering restarting quantitative easing? So we're going to shoot over to Zero Hedge. The title, FOMC minutes confirm Fed pause, potentially QT taper. Officials blame Trump policies for uncertainty. So this really doesn't make a lot of sense to me, because if you see what they're talking about in the Fed minutes, they're talking about the uncertainty is the tariffs may cause additional inflation. Okay, well, why on earth would you scale back QT, maybe put it on pause if you were worried about inflation? Wouldn't you do the opposite? I'm not saying that the Fed balance sheet matters. I'm just trying to look at this through their lens or through the narrative they try to get you to believe. Let's get back to the article. Since the last FOMC meeting on January 29th, the market has coped admirably well with the utter avalanche of headlines spewing from Washington. Gold has been the standout, that's for sure, while stocks, bonds, oil, and dollar are about flat, but with a lot of volatility. Makes things very hard for investors when you're just going sideways and it's up and down, a lot of chop. The macro data has been a nightmare with stagflationary. Well, I know Zero Hedge likes to use this term loosely, but come on, the CPI is at 3%. We've gone from 2.4 to 3. Now, I understand the CPI dramatically understates inflation. I get it. But I'm just using that CPI as a trend. And so we went from inflation to disinflation, not deflation. Prices didn't go down. They just went up at a slower rate, down to 2.4 as measured by the CPI, and we're up 60 basis points. So stagflation, I don't know. And then the unemployment rate is actually coming down. So I'm not saying it's a good economy. It's a terrible economy for the average Joe and Jane, but to call it stagflationary, yeah, not really. Let's see. Getting back to it, as growth surprises have been to the downside, while inflation surprises have soared to the upside. Again, soared. Come on. Which explains why rate cut expectations have tumbled since the last FOMC statement. And look, even by their own chart, the rate expected. Look at this. They're talking about from here to here being soaring. I can't be too hard on Zero Hedge. They're one of my favorites, but they do like to embellish, let's say, slightly. And I guess for me, that's the pot calling the kettle black when you look at my thumbnails and my titles. Fed speak since the last meeting has been guarded hawkishly, with Powell reiterating his no rush to cut comments and various other Fed heads noting the central bank in a good place after they removed optimistic inflation keeps trending down language from their prior statement. You know, it's crazy that the market just hangs on their every word. And I talk about it just because this is a channel where we talk about what's in the news. And so this being in the news, we're going to talk about it. It's a big deal what the Fed's doing with their balance sheet, at least from a news standpoint. From a mechanical standpoint, I don't think it matters really one way or the other. But obviously from a psychological standpoint, it does. But you got to ask yourself, how did we get here? Like, really, how did we get to a point where our financial system is so screwed up, where our economy is so upside down that every single person out there, not every person, but every person in the financial economy for sure, and then a lot of the average Joes and Janes are just hanging on every word Jerome Powell says as though it's going to mechanically move the market and, more importantly, the broader economy. I mean, I always go back to one of the first conversations I had with Jeff Snyder, and I asked him what would be his definition of success as far as what would you need to see happening in the real economy to know that we're really making improvements. And he said for no one to know the name of the Fed chair. And you think to yourself, oh my gosh, that's so unrealistic. That's never going to happen. But if you just go back in time, I mean, just go back to the 1940s, 1950s, 1960s. Nobody knew who the hell was running the Federal Reserve. That was not a household name. And it wasn't even a household name in the financial media. How do I know this? Because as you guys know, one of my hobbies is to go back and read headlines and articles from the Wall Street Journal going back to the 1940s and even back further. And I remember in the 1940s, I chose the 1940s specifically because supposedly that's when the Fed was doing all this yield curve control and buying all these bonds, and they were really proactive, let's say, in the markets. And I go through Wall Street Journal after Wall Street Journal after Wall Street Journal in the 1940s, and I can't find a mention of not just the Fed chair, but the Federal Reserve, period. Now, I'm sure if I really scrutinized it, I could find it here and there. But nowadays, I mean, you go through a Wall Street Journal and every other word, for heaven's sakes, is Federal Reserve, or at least every other article, right? I mean, I go through Bloomberg and they have a whole section, they have a whole tab for central banks. But the point was, back in the day, that was not a thing. And even prior to the 1970s, people that knew about the Fed, they thought they were a joke. They didn't think they had any power. They didn't pay any attention to them. So again, how did we go from that to where we are today? And ask yourself, was the economy more sound? And I'm not saying the 70s with the inflation and everything, but prior to the 1970s, was the economy more sound then than it is today? I would argue absolutely. If you consider a sound economy being one where the focus is on producing goods and services, as opposed to the focus just being on number go up with fart coin, which is where we are today. So let's start a movement. It's not just end the Fed. Let's forget the Fed. Getting back to the article. Here are the initial highlights. Fed's on hold confirmation. Zero Hedge points out the Fed's 19 officials who participate in the interest rate decision indicate they want to see further progress on inflation before making any further cuts. Okay, then why are you contemplating the pause on QT? I thought that through the Fed, you're reducing liquidity, and supposedly that's going to help drive down the inflation rate. Fed blames Trump. The minutes also cited high degree of uncertainty surrounding the economy, which made it appropriate for the Fed to take a careful approach in considering any further changes to key interest rates. Fed officials said Donald Trump's proposed tariffs, mass deportations of migrants, as well as strong consumer spending were all factors that could push inflation higher. Okay, then why aren't you raising rates? Like, it's just, it doesn't, there's so many contradictions. And it's one of the things that I've pounded the table on since starting this channel in 2021. It's like when the central planners tell you something that doesn't make sense, you've got to dig into what they're saying and you've got to scrutinize it with a high degree of skepticism. And usually when something doesn't make sense, it's because they're lying. It's because they're lying. At least that's been my experience going back to 2020. I mean, almost every single time it doesn't pass the sniff test, then it's because they're lying or they're trying to push some sort of narrative. In other words, just push some sort of propaganda. Monetary policy. Some participants cited potential changes in trade and immigration policies as having potential for hinder disinflation process. Okay. Vast majority of participants judge risk to dual mandate objectives were roughly in balance. A couple of participants noted it appears risk achieving inflation mandate were greater than risks to unemployment or to employment mandate. Majority of participants observed that the current high degree of uncertainty made it appropriate for community to take a careful approach in considering adjustments to the monetary policy. Okay, let's look at the balance sheet here. That's what I'm more focused on. Various participants noted it may be appropriate to consider pausing or slowing balance sheet runoff. Why? If the risk is to the upside with inflation, then you should be accelerating the balance sheet runoff. Again, looking at it through their that's not my view, but looking at it through their framework, right? Again, I don't think their balance sheet really matters mechanically, but to them, they would argue that it absolutely does. And that if they're increasing QE, then why are they doing that? In their words, or in their view, it's to lower interest rates, to increase liquidity, to stoke inflation. What were they doing when they were trying to get the inflation rate up to 2%? Well, they're trying to do that not that long ago. Remember, that was the problem? Deflation. What were they doing? They dropped rates down to zero, and they were doing quantitative easing to try to get the inflation rate up to their 2% target. Remember those days? Okay, so if you're trying to get inflation down, and if that's the risk because of all these tariffs, wouldn't you do the opposite of QE, which is QT? Or would you pause that? Again, see how they're contradicting themselves within their own statement, within their own minutes. And to me, that doesn't pass the sniff test, and that tells me they are lying. Reserves might decline quickly upon resolution of the debt limit, and at the current pace of the balance sheet runoff might potentially reach levels below those viewed by committee as appropriate. All right, let me explain this to you guys. This drives me crazy, but just let me explain to you what they're talking about here. Let me pull up a chart of the bank reserves in the system, and then I'm going to explain why this is just complete and total nonsense and hubris, really. So here's what they're talking about. They're talking about the debt ceiling. So let's see if I've got the TGA. I don't, but so you guys know this from watching my videos. The TGA is a component of the liability side of the Fed's balance sheet. That's Janet Yellen, or now Scott Bessent's checking account, the Treasury. So if they're getting to the point where they're hitting a debt ceiling, right, then that means they're not able to issue as much debt as they would like. Okay, well that means that they can't spend as much money as they would like, and therefore what they're doing is there aren't the same amount, the same amount of bank reserves going out of the TGA into the reserve accounts for the banks. Because remember, there's three major components of the liability side of the Fed's balance sheet: the bank reserve accounts for the mega banks, let's say, the TGA, and reverse repo. So reverse repo is almost drained. That means no more, let's just say, bank reserves going from reverse repo into the accounts of the mega banks. And if we get to a point where there's fewer reserves coming out of the TGA, then that means there's fewer reserves going into the accounts of the mega banks. And while they're doing all else being equal, that is going to shrink the amount of the reserves, because you don't have the TGA liquidity or the reverse repo coming out of the account to offset what's happening with QT. So you see right here that from December 22 up to today's date, the net increase, or there is a net increase in bank reserves. But if you looked at the Fed's balance sheet, they would have done massive amounts of, you see, from here all the way to here. And why I mean massive amounts? I'm talking about, I mean, we're at 6.8. We're looking at over 2 trillion, over 2 trillion of QT, but yet the amount of reserves in the system has actually increased slightly. How is that possible? Because those reserves were more, the reserves that were coming out of the TGA and the reverse repo were more than offsetting the decline of the reserves due to quantitative tightening. So this is what the Fed is referring to. Now, getting back to the amount of bank reserves and the hubris and this, why this is just total nonsense, is because look at how many reserves were in the, I mean, I point this out all the time, but look, there were no reserves in the system prior to QE, no reserves. So in other words, the whole entire global monetary system was functioning without any, or effectively without any reserves. Okay. So now all of a sudden you're going to say that, oh my gosh, 3.2 trillion just isn't enough. How do you figure? And even if you want to say, okay, well, George, it's QE times, abundant reserves, it's a lot different now. I would argue, no, it's not. But even if you want to have that rebuttal, fine. Look at when we had a problem with the system. That was September 2019. And at that point, the reserves were 1.5 trillion. Now, I would argue the repo blowup was not a result of lower bank reserves. But even if that is your argument, fine. We've still got a delta of 1.7 trillion. And you Fed officials are telling me that you're so smart that you know for sure, based on all your models that we know are incredibly, incredibly accurate, that at 3.2 trillion, we're getting real close to that moment when the monetary system just isn't going to have enough bank reserves, which they don't really need to begin with. And the reason I get so frustrated with that is because it's just the Fed trying to dupe you into believing they have all of this power. It's the Wizard of Oz just trying to pull the wool over your eyes, because they think that you're going to believe that they're not just this little teeny guy that's just moving this lever here and there, that you believe that they're this all-powering, let's go with that word, a little easier to say, that they're this all-powering individual or entity that can really just whatever they say, whatever they do is going to impact the economy, and they control the GDP. They control interest rates. They control liquidity. They control the dollar. They control all this. They control the unemployment rate. Blah, 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 blah. When in reality, they're just this pipsqueak. Reality, they're just the Wizard of Oz behind the curtain. And it's all a giant psyop to get you to believe something that will prompt you to take the action they want you to take. They're manipulating you. They're manipulating the citizens. They're manipulating the financial market. They're manipulating the average Joe and Jane. They know they're doing it. They know that these psyops are their only real power because they actually state it. If you want to really get into the nitty gritty with the Fed minutes and what they say, you go back to the 1980s and they openly admit this stuff. And that's what frustrates me. It's like, can we get to a point now where we just call a spade a spade? Can we get to a point where we just end the ruse here? And we're all going to be better off for it. Just get rid of the damn Fed, get rid of their stupid psyops, get rid of Jerome Powell. And I've got a novel idea. A lot of people would say, oh my gosh, well, what would replace the Fed? I know. How about market interest rates? How about we let the market set the front end of the curve? How about we let the market set interest rates? What a novel idea. You don't think the market could set better interest rates than the Fed? And then if interest rates go up, they go down. Fine. That's what the market is doing. And they're doing it for a reason. You know what's bananas to me is every single economist out there, whether they're Keynesians, Austrians, monetarists, it doesn't matter. They all have one thing in common. And they all say that price controls are bad. Even Krugman, price controls are bad. But yet somehow all of them say that if we have this central planner that's setting the price of money, interest rates at the front of the, well, then that's not only good, that's absolutely mandatory. We have to have that. You know, sure, we want the price signal in the real economy, and we want price discovery, and we want all these things, and we want the market to set prices there. But heaven forbid we have that with the cost of money or credit or debt. Come on. Again, can't you see them contradicting themselves? And when they contradict themselves, that's when you know it's lies. That's when you know it's propaganda. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.